So something pretty wild is happening in the market right now, and honestly, I feel like most people are either totally unprepared for it or they're about to make a very expensive mistake. The SpaceX Roadshow has officially kicked off. We've got about 8 days until June 12th, which is when SpaceX is going to start trading publicly for the very first time. And look, this isn't just another IPO. This is potentially one of the biggest wealth-generating events we're going to see in our lifetimes, if you play it correctly. If you don't, well, that's a different story. So today I want to walk you through 4 things. First, what's actually going on with the SpaceX IPO right now? Like the real details, not the hype. Second, how to actually position yourself so you're not just chasing price. Third, I'm going to run through the stocks and partners that I think are genuinely set to benefit here. And fourth, and this is probably the most interesting part of today's video, there's one specific stock, a SpaceX adjacent company that SpaceX actually owns a piece of, and it's trading around $4 right now. I'm going to make the case for it and let you decide. As always, though, I have to say it. If you're the one taking the risk, you need to be the one doing your own research. I'm not your financial advisor. Okay, with that out of the way, let's get into it. So right now, SpaceX is in what's called the roadshow period. Basically, the executives and their bankers are out on the road, traveling around, pitching the deal to the biggest money in the world. We're talking giant pension funds, hedge funds, sovereign wealth funds, basically the institutions that manage trillions of dollars. And the way a traditional roadshow works is a big fund comes in, says how many shares they want and at what price, and then the bankers look at all those orders and figure out where to set the IPO price. The whole point is to test demand before you actually open trading, so you don't end up with a stock that craters 90% on day one. Normally, a company gives you a price range, something like $120 to $140. And the roadshow narrows it down to one final number. But SpaceX, they're reportedly skipping all that and just going out at one fixed price, $135 a share. And that is a power move if I've ever seen one. It's basically saying, we don't need to test demand. We already know it's there. Here's the price. Take it or leave it. Nothing is official until pricing night on June 11th, but that's the number being thrown around. And between now and then, you're going to see a flood of press releases, analyst notes, media speculation, all of it designed to build a narrative around the valuation. Speaking of which, this morning, Goldman Sachs, who is one of the banks working on this deal, came out and said they expect SpaceX's AI revenue to increase 100 times by 2030. 100 times. That would put SpaceX's AI revenue at around $322 billion. And just to put that in perspective, NVIDIA, the most AI revenue-generating company on the planet right now, is on track to do somewhere between $230 and $300 billion for 2026. So Goldman is essentially saying SpaceX could, by 2030, surpass what NVIDIA is doing today. That is a bold statement, like genuinely bold. But here's why it matters beyond just the number itself. Bears had been pointing to SpaceX's AI division as a money-losing drag. Goldman just flipped that narrative on its head entirely. If this forecast gains any traction at all, analysts are going to use it to justify much higher valuations for years. Let me give you the full timeline so you know exactly what's coming. June 4th through June 11th is the roadshow. Bankers pitching, media running articles, building the narrative. June 11th, Thursday night, that's pricing night. The final IPO price gets locked in and shares get allocated to institutions. June 12th, Friday, trading begins. SPCX opens on NASDAQ and NASDAQ Texas, and that is the first morning ever that anyone with a regular brokerage account can buy a piece of SpaceX. Then, somewhere around June 7th to June 9th, options will likely go live. Just know that implied volatility is going to be north of 100% in that first week, and bid-ask spreads are going to be very wide because liquidity will be thin early. Now here's something that not enough people are talking about. Early July, there's a NASDAQ 100 fast entry window. Under NASDAQ's rules, SpaceX becomes eligible for NASDAQ 100 inclusion after just 15 trading days of being public. 15 days from June 12th lands right around early July. And what that means is that every NASDAQ-based ETF, trillions of dollars in passive funds, will have to mechanically buy SPCX at whatever price it's trading at. They have no choice. That is forced buying. Most companies wait months, sometimes years, before being added to major indexes. SpaceX gets 15 days. That is a structural tailwind that is basically built into the schedule. Then later in the year, you'll get the first public earnings report, somewhere in the September to November window. And I'll be honest with you, I expect that to be a rough moment. Markets tend to punish money-losing companies on their first earnings report, no matter how good the story is. And then the lockup schedule is staggered and tiered rather than a single 180-day cliff, which is actually kind of unusual. First unlock comes around the September earnings report, then rolling waves after that, with the bulk of insider shares clustering into December 2026. Musk himself and certain major investors are locked up for a full 366 days, which is actually a confidence signal. Okay, now let me be very direct about something because I think a lot of people are genuinely going to get hurt here. IPO stands for, and yeah, the joke is old, but it's still true, it's probably overpriced. Companies love to IPO in hot market conditions because they want to sell as high as possible. The people buying at open are almost always chasing price well above what institutions paid. You get a massive pop, then the selling happens over time, and the stock bleeds out lower. For most people, I'd say 95% or more, I would not buy SpaceX at the open. It's not a long-term value buy at IPO prices. And even if you're trying to trade it short-term, you're probably going to get a terrible fill. Submit a market order at $150, you might get filled at $160, $175, and then if you try to exit, the stock can reverse fast and you get burned on both sides. That said, there are 5 real reasons why SPCX is likely to pop very hard at open. 1, there aren't enough shares. Only around 555 million shares being sold, which is a tiny slice of a company this size. Way more money wants in than there are shares. 2, years of pent-up demand hitting all at once. SpaceX has been the most wanted private company on Earth for a decade. June 12th is literally the first time in history anyone with a brokerage app can buy it. 3, the deal looks built to pop. Going out at a fixed $135 instead of letting demand push it higher suggests they may have intentionally left some money on the table, which means headroom to run. 4, story stock dynamics. Rockets that land themselves, Starlink, Grok, Mars. Nobody has built a stronger financial cult following than Elon Musk. The more it goes up, the more people pile in. The more media covers it, it feeds itself. 5, algo traders know about the forced buyers. They're going to front-run the NASDAQ inclusion buying because they know the passive funds have to buy regardless of price. So yes, aggressive pop at open is likely. But long-term, I think it bleeds out over the following 6 months. That's the more realistic trajectory here. Now, the best way I've found to play this IPO actually has nothing to do with buying SpaceX directly. It's about the repricing of the entire space basket that happens around a major IPO like this. One clean way to get broad exposure is the ARKX or the UCITS Space ETF, or specifically the Space Innovators ETF, which holds Rocket Lab at about 6.91% and includes names like MDA Space, Space Mobile, Planet Labs, EchoStar, Intuitive Machines, Firefly, and others. If you want the whole basket without picking individual names, something like that is one way to approach it. But I do need to warn you, and I want you to really hear this. I've seen this cycle before. Virgin Galactic's 2021 run is the example I keep coming back to. If you bought near the high, you are now down roughly 99.78%. That's not just hype and dump behavior. That happened because the company diluted relentlessly. Shares outstanding ballooned even after a reverse split. Most of these space companies cannot cover their expenses from revenue alone. So they dilute just to keep the lights on. The stock becomes a long-term hot potato, lucrative if you time it right, devastating if you get stuck holding. Let me run through the stocks I'm watching, and I want to be clear about which are quality long-term companies versus which are just hot potato plays. So first up, Momentus. We pointed this one out Sunday, May 24th. It closed that Friday at $7.38, and today it's around $16. Really strong run. But let me be honest right away. This is the more speculative and harder to justify holding long-term play compared to what I'm about to tell you next. Momentus designs and builds in-space infrastructure. Their main product is a vehicle called Vigoride, which rides up on a SpaceX rocket and then acts like a shuttle, moving customer satellites to their specific orbits. They've got relationships with DARPA, the Space Force, NASA, and Golden Dome related programs. I still like MNTS heading into the IPO window. There could be more highs before and maybe just after, but there's a dilution registration currently sitting with the SEC. Once it gets approved, the company can issue massive amounts of new shares. If you're trading into the IPO window, that may not be your immediate problem, but long term, it matters enormously. Next, Sievert or Sidus Space, Sidus. This one is honestly one of the hotter hot potato stocks in this whole basket. Small Florida-based space as a service company. They design, build, launch, and operate small satellites, then sell the data those satellites collect, imagery, sensor readings, to U.S. government clients, defense agencies, commercial businesses. Key catalyst to watch: Russell 2000 index inclusion slated for June 26th. That alone could be a 10 to 30% move. And the SpaceX IPO could add another 5 to 20% on top of what's already priced in. They did just complete a large offering that cleaned up their balance sheet and extended their runway, so there's that. High dilution company long term, but right now there's a unique window, which is exactly why I wanted to bring it up today. Then there's Redwire. This has been one of our most successful ideas. We called it out May 5th at around $8.69. It's now hovering around $21.72 and hit $25.90 at its highs. And genuinely, I think Redwire is one of the best quality long-term stocks in this entire basket. Here's why. They're riding two massive megatrends simultaneously: space and defense. They build actual hardware that goes into space: solar arrays, docking mechanisms, platforms for science experiments, manufacturing infrastructure in orbit. They had 11 active payload facilities on the International Space Station as of end of 2025. And then in June 2025, they acquired a drone company called Edge Autonomy, which added a second business making small military reconnaissance drones for the U.S. military and NATO allies. Two businesses, two expanding markets. My view on timing. I think you see more highs around the SpaceX IPO than meaningful profit taking as the narrative fades. Long term, though, I see significant upside. If you're buying for the long term, consider waiting for the post-IPO dip to get a cleaner entry. Okay, now the main event, Filtronic. Right now, I think this is one of the single best deals available in the entire space basket. High risk, yes, like the others, but in terms of bang for your buck, this one stands out to me, and it's trading around $4. Filtronic is a small British company that makes specialized radio hardware for satellites, specifically power amplifiers, the components that let satellites beam massive amounts of data down to Earth without the signal breaking down. If a satellite is trying to shout data down to the ground, Filtronic builds the megaphone. And not just any megaphone, they build the high-end ones operating at what's called E-band frequencies, where you can push the most data. They use a material called gallium nitride, which lets you pack more power into a smaller, more efficient chip. More power plus more efficiency equals faster, higher capacity satellite internet. And their single biggest customer, by a very wide margin, is SpaceX. About 83% of Filtronic's revenue comes from SpaceX, which uses these amplifiers in Starlink. Every time Starlink wants to add capacity or boost speeds, it needs more and better versions of this hardware. Filtronic literally just signed its largest ever order, around 47 million pounds, to supply SpaceX's next generation amplifiers. But here's what really gets me. SpaceX doesn't just buy from Filtronic. SpaceX owns a stake in them. Through warrants, essentially the right to buy shares at a set price, SpaceX already controls close to 10% of the company, and that can grow toward 15% as Filtronic keeps delivering new technology. What is soon to be one of the most valuable companies on the planet took an ownership stake in its own little supplier. That is an enormous vote of confidence. That is not a vendor relationship. That is a partner relationship. And here's the big distinction between Filtronic and almost every other name I've covered today. Filtronic does not need to dilute to survive. It is already profitable. It generates cash. It sits on a net cash position and funds itself from its own operations. That whole dilute shareholders into the ground just to keep the lights on dynamic does not apply here. Could they dilute someday for an acquisition or a big expansion? Sure, but there's no survival pressure. This is a profitable, cash-generating business right now. The catalysts I'm watching. First, the SpaceX IPO basket repricing. I think there's another 15 to 40% potential just from that dynamic alone. Second, their upcoming earnings for financial year 2027. With the enormous TAM the SpaceX IPO is blowing open for the space economy, I expect management's outlook to be very bullish, which could be another 10 to 30% move. Third, any customer diversification win. A US or EU defense contract announcement would be a meaningful catalyst. Fourth, the 47.3 million pound GaN E-band order ramping. I expect more detail on earnings as that ramps through 2027. Probably another 5 to 20% on that news. Fifth, new next generation GaN product launches throughout 2026 and into 2027. Based on previous runs, each meaningful launch announcement could be another 5 to 15%. A profitable, cash-generating company with the deepest possible relationship with what's about to be the most talked about IPO in history, trading around $4. That's the setup. Make of it what you will. Anyway, folks, that's everything I wanted to cover today. Let me know in the comments your favorite space stocks and how you're thinking about playing the SpaceX IPO. And as always, do your own research. I'll see you in the next one.